Most of the Magnificent Seven lower on the week. The worst performer, Nvidia, which fell after it couldn't quite meet the hugely inflated expectations that had built up into Wednesday's earnings. Joining us now on Big Tech, Dan Niles, Niles Investment Management founder and portfolio manager. Dan, I saw a really interesting stat in the producer's notes for this segment from you, which is that the Mag 7 have now declined on average 4% the day after reporting results versus rising 4% after Q1 results. Does that suggest to you a sentiment shift or a fundamentals shift?
Well, it's clearly a fundamental shift, because if you look at the results of the Magnificent Seven and you forget all the hype, after Google reported, their forward revenue estimates went down. After Amazon reported, their forward revenue estimates went down. After Microsoft reported, their forward revenue estimates went down. So I know it's popular to talk about AI because these stocks are driving the market, but at a certain point, you want to get a return on all of this money you're investing. And if your forward revenue estimates are going lower, not higher, but your CapEx is going up, at some point, those two things are going to collide. And we saw this after COVID, where spending took off and then slowed down dramatically as these same companies went through a digestion period. And that's what I think you're going to see happen as we get into next year.
The digestion period indicating that there needs to be a very clear ROI on all of this CapEx spending, which some investors feel dissatisfied by.
Exactly. I mean, and you can think about it just from looking at NVIDIA, the poster child of AI. During COVID, obviously, everybody had to get online, and all of these same hyperscalers went ahead and spent a lot of money. And if you go back and you look at it, during 2021, revenue growth for NVIDIA was up 62% year over year. 2022, revenues were up 6%, and the stock went down from peak to trough 66%. And so if you look at CapEx spending over the last 2 years, and you see NVIDIA's revenues last year grew over 100%. This year, they're going to grow over 100%. I think what you're going to see next year is a dramatic slowdown, not only from the spending from the hyperscalers, but also in NVIDIA's revenues as those hyperscalers grow into all of this money that they've spent that's not actually generating an increase in their revenues. And so that's what you're going to have to deal with. And we've seen this after COVID. But investors obviously don't want to believe this because it's going to be really painful. But you can see it in the revenue figures for the big hyperscalers and how they're going down, not up, after they report it.
Is there an argument to be made? I mean, we get PCE in about 8 minutes. So I have to ask you a rates-related question as it pertains to CapEx, which is that a lot of what we've seen over the last few years has defied kind of Econ 101 in terms of CapEx spending because of this clamoring for AI, as well as the enormous amount of cash on the balance sheets of large tech. But as you do see rates come down, is there an argument to be made that more of the CapEx spending could be kind of built up by those who haven't necessarily been spending because financing that CapEx suddenly becomes cheaper?
Yeah, I think if you think about the market, July 16th, that's where the S&P hit its peak, and the S&P is down about 1% from there. The Magnificent Seven are down 8%, but the equal weighted S&P is up 2%. And so we've been saying this for a while. In terms of what we're looking at to invest in, it's the areas that benefit from rate cuts. And so it's areas like consumer staples, utilities, telecom services, other sectors of the market, because it's that other 493 stocks is our belief that drives this market to new all-time record highs. And we still like, don't get me wrong, we like Apple, we like Meta, because there we see revenues actually doing well. They had forward revenue estimates go up. But I think you really have to look outside of just 7 stocks through the rest of this year, because rates going down is going to benefit a whole lot of other sectors of this market, just like you brought up.
Yeah, you're working with about 70% of the S&P market cap, I guess, if you're talking about the 493, trying to drive the index to new highs. I guess, Dan, for that to happen, you must assume the economy is going to hang together pretty well. Therefore, earnings growth can spread out among more companies? Absolutely,
Mike. I mean, we look at jobs as the #1 driver of everything. And if you think about this whole debate of, what's the economy going to do? It's hard for me to imagine the economy slows down that much if you've got 10% more job openings than people unemployed. And this is the same reason why several years ago we were saying this is not transitory inflation, because you had 2 times as many people 2 times as many job openings as people unemployed. So you look at that, you look at GDP running around 3%, you look at the fact the Fed's going to cut probably 3 times this year to get the Fed funds rate closer to where inflation's actually running. Obviously, we're going to get the PCE report very shortly. But you look at all of that and you say, okay, this should be good for the economy in general, and these other stocks that people have forgotten about, who I think will do pretty well over the course of the next 12 months, where a lot of the Magnificent Seven, I think you're going to see their revenue growth actually slow down a little bit. But that's not a bad thing. You can have these other 493 stocks actually doing quite well, which is what we've seen since the middle of July.
So then would you be using any dips in the Mag 7 as buying opportunities? Or at this point, given just the estimates in the future, you'd be sitting that out?
Well, right now, the two that we like Apple a lot. I mean, Apple's had very little growth for the last 3 years. It grew 4% 2 years ago, grew 0% last year. Sorry, 2% 2 years ago, 0% last year, 4% this year. I think next year, driven by people actually upgrading their iPhones, which they last did during COVID, you're going to see that growth rate be over 10%. And so I think that's very interesting. Meta is very interesting. But you look at the other names in there, I think NVIDIA is going to go through, obviously, CapEx digestion, which we've talked about. Microsoft should worry you because despite their relationship with OpenAI, they missed their Azure numbers. Amazon, obviously, e-commerce, I thought there would be share gains. They could do that profitably. Margins came in worse than people thought. And with Google, I don't see how they keep 90% plus share in search when you've got all of this spending on AI going on. And you got to believe some of those companies take share. And then Tesla's just obviously in a tough competitive environment. So it really, you got to go through each one individually. It's not a uniform buy them all or sell them all.